Did you know that just 2 ETFs could potentially outperform your full-time job in generating wealth over time? It sounds surprising, but it's true. In this video, we're going to explore the key strategy behind this powerful investment approach. You'll discover how combining the right ETFs can create a portfolio that not only keeps pace with the market, but potentially surpasses it. We'll look at 4 different ETF combinations that could make this possible. Stay tuned to learn how you can put this strategy to work for your financial future and why it might be more impactful than you'd expect. Imagine Wall Street's brightest minds gathered in towering skyscrapers, focused on one goal: beating the market. It's a common belief that their complex investing strategies must yield better results. After all, they're the experts, right? But here's the surprising truth. This complexity often leads to underperformance. Despite their resources and expertise, most active managers fail to beat the market consistently. Studies have shown that over the long term, around 80% of actively managed funds underperform their benchmark indices. That's a staggering statistic considering the billions of dollars invested in these funds. A major factor in this underperformance is the impact of high fees on long-term returns. Active management comes at a cost, and those fees eat into your returns year after year. Even a seemingly small difference in fees can have a massive impact over time due to the power of compound interest. Let's break it down with some numbers. If you invest $10,000 in an actively managed fund with a 1% annual fee growing at 7% per year before fees, after 30 years, you'll have about $61,000. However, if you invested in a low-cost index fund with just a 0.1% fee, you'd end up with around $75,000. That's a difference of $14,000, all because of fees. This raises the question, is there a simpler, more effective way to invest? What if you could capture the growth of the market without the high fees and complexity of active management? Enter the concept of a 2 ETF portfolio. It might sound too simple to be effective, but sometimes simplicity is the key to success. Warren Buffett, one of the most successful investors of all time, has stated that a long-term investment strategy using low-cost index funds can outperform most investors who use high-fee managers. Imagine building a diversified portfolio with just 2 carefully chosen ETFs. You could potentially match or even beat the performance of complex, actively managed portfolios while keeping your costs low and your strategy simple. In the next section, we'll explore this streamlined approach in detail. You'll see how combining just 2 ETFs can provide comprehensive market coverage, balance risk and reward, and set you on the path to long-term financial success. Get ready to discover the power of simplicity in investing. 2 ETFs can indeed capture the entire global market, offering a streamlined approach to unlock your investment potential. Let's explore how this combination of funds provides broad exposure to both stocks and bonds worldwide. The Vanguard Total World Stock ETF, VT, holds approximately 9,000 securities, giving you exposure to developed and emerging markets across various sectors. It's like owning a slice of every major company on the planet. The geographic distribution is impressive, with about 60% of its assets in North America, 20% in Europe, and 10% in Asia. Complementing this, the Vanguard Total World Bond ETF, BNDW, offers exposure to over 8,000 fixed income securities, including government, corporate, and international bonds. This comprehensive coverage helps protect your portfolio during stock market downturns and provides steady income. Global diversification is crucial. Academic studies have shown that it can reduce portfolio volatility and enhance returns. This is particularly evident during market downturns when different regions and asset classes don't always move in the same direction. This approach minimizes overlap and reduces complexity. Instead of picking individual stocks or juggling multiple sector-specific funds, you're getting broad market exposure in the simplest way possible. This eliminates the need for constant rebalancing and reduces the risk of underperformance associated with active stock picking. The strategy has the potential to deliver market-matching returns at a fraction of the cost of actively managed funds. With a 2 ETF portfolio, you can keep your costs low, allowing more of your money to compound over time. The power of this approach lies in its flexibility. You can easily adjust your allocation between stocks and bonds based on your risk tolerance and investment horizon. Young investors might lean heavily towards stocks for growth, while those nearing retirement could shift more towards bonds for stability. As we move forward, we'll take a closer look at 2 specific ETFs that could form the backbone of this strategy. These funds have the potential to not only match market performance, but possibly even surpass it over the long term. Discover how these 2 tickers could become the cornerstone of your financial future. Have you ever considered combining dividend investing with growth stocks? Let's explore DGRO and QQQ, 2 ETFs that could transform your investment strategy. These financial powerhouses might just hold the key to your financial future. The iShares Core Dividend Growth ETF, DGRO, focuses on U.S. companies with a history of consistently growing dividends. It's about sustainable, increasing payouts rather than just high yields. Since its inception in 2014, DGRO has delivered an impressive average annual return of 11.6% with a dividend yield of around 2.3%. What sets DGRO apart is its inclusion of tech giants like Apple and Microsoft, giving you exposure to both stable dividend players and companies with strong growth potential. This unique approach, combined with a low expense ratio of 0.08%, makes DGRO an attractive option for investors. Now let's take a look at the Invesco QQQ ETF. This fund tracks the NASDAQ 100 index, home to the 100 largest non-financial companies listed on the NASDAQ. If you're seeking innovation and growth, QQQ delivers. It includes companies at the forefront of technology and consumer trends such as Apple, Microsoft, Nvidia, and Google. QQQ's performance has been remarkable, with average annual returns of nearly 19% over the past decade, significantly outpacing the broader market. While its expense ratio of 0.15% is slightly higher than DGRO's, it's still competitive for the high-growth exposure it provides. Combining these 2 ETFs creates a balanced approach to investing. DGRO offers steady income and stability with its focus on dividend growth, boasting a 5-year annual dividend growth rate of 99.7%. QQQ complements this with exposure to innovative companies and massive growth potential. A 50-50 portfolio of DGRO and QQQ could provide you with a steady stream of growing dividend income while also capturing the upside of high-growth sectors. This balancing strategy aims to weather various market conditions by diversifying across stable dividend growers and cutting-edge tech companies. Looking ahead, experts remain optimistic about the long-term prospects for both dividend growth stocks and innovative tech companies. Dividend-paying firms are expected to continue prioritizing shareholder returns even during market volatility. Meanwhile, the companies in QQQ are driving technological advancements that could shape our future economy. In our next section, we'll put this dynamic duo to the test. We'll examine how a DGRO and QQQ combination performs against traditional investment approaches in various market conditions. You'll see how this simple yet powerful strategy could potentially enhance your investment portfolio. Is a simple investment strategy about to challenge the Wall Street giants? Over the next few minutes, we'll explore a 10-year showdown between our 2 ETF portfolio and the broader market. The result might surprise you and potentially change how you think about investing. Let's set the stage for our performance comparison. We're comparing our 50-50 DGRO and QQQ portfolio against the Vanguard S&P 500 ETF, VOO, which represents the broader market. Our time frame spans a decade of market fluctuations, including some major economic events. As we break down the performance quarter by quarter, our 2 ETF portfolio isn't just keeping up, it's taking the lead. Over the 10-year period, this straightforward strategy outperformed VOO by providing higher average annual returns of about 3% per year. That might not sound like much, but when you compound those returns over time, the difference becomes significant. To put it in perspective, if you had invested $100,000 in our DGRO QQQ combo at the start of this period, you'd end up with over $7,000 more than if you had invested in VOO alone. That's the impact of consistent outperformance, even by small margins. During this decade, we experienced significant market volatility, including the economic impact of the COVID-19 pandemic. Yet, our 2 ETF portfolio showed remarkable resilience. In its best year, it outperformed VOO by over 34%, highlighting its potential during strong market conditions. Interestingly, our portfolio moved closely with the broader market. The correlation between our DGRO QQQ mix and the S&P 500 was 98, meaning they generally moved in sync. However, our portfolio managed to consistently achieve those extra returns. As we approach the end of our 10-year journey, the final performance numbers reveal a clear winner. Our 2 ETF portfolio not only held its ground, but came out ahead. So how did this simple strategy manage to outperform sophisticated Wall Street approaches? In our next section, we'll explore the reasons behind these surprising results. We'll look at how factors like lower fees, reduced trading, and behavioral advantages contribute to the success of this straightforward yet effective investment approach. What if I told you that beating sophisticated investment algorithms doesn't require more complexity, but less? There's a hidden advantage in simplicity that many professional investors overlook. Let's uncover why our 2 ETF strategy is so effective. We've seen how our straightforward DGRO and QQQ portfolio outperformed the broader market over a decade. But why does this simple approach work so well? It might seem counterintuitive, especially when we're consistently hearing about advanced trading algorithms and teams of expert analysts. The truth is, simplicity offers several advantages that complex strategies often miss. One of the most significant benefits is low fees. Our 2 ETF portfolio keeps costs incredibly low, with expense ratios under 0.15%. This might not sound like much, but it makes a huge difference over time. For example, if you invest $10,000 and earn 7% annually, after 30 years you'd have about $76,000 with a 0.1% fee compared to only $61,000 with a 1% fee. That's $15,000 more in your pocket just from keeping fees low. Another advantage is reduced trading. When you're constantly buying and selling, you're not just incurring transaction costs, you're also potentially triggering taxable events. Our 2 ETF approach encourages a buy and hold strategy, which can be much more tax efficient in the long run. Perhaps the most powerful benefit of simplicity is how it helps us avoid common behavioral mistakes. A simple, easy-to-understand portfolio can alleviate anxiety about investing and help investors stay the course. When markets get turbulent, you're less likely to feel overwhelmed or tempted to make rash decisions with a straightforward strategy. By maintaining a simple, low-cost portfolio, you're setting yourself up for long-term success. You're reducing stress, minimizing costs, and giving yourself the best chance to capture the market's returns over time. As we move forward, let's explore how you can put this powerful strategy into action. We'll break down the steps to build your own 2 ETF portfolio, address common concerns, and show you how to tailor this approach to your unique financial situation. Ready to build your 2 ETF portfolio? Let's break down the process into simple, actionable steps. First, consider your allocation between DGRO and QQQ. This ratio should reflect your personal risk tolerance and investment goals. If you're younger with a longer time horizon, you might lean more towards QQQ for growth potential. If you're closer to retirement, a higher allocation to DGRO could provide more stability and income. Online risk tolerance questionnaires and investment calculators can help you find the right balance that aligns with your financial situation. Worried about market timing? Dollar cost averaging can help. Instead of investing a lump sum, consider investing a fixed amount regularly. This strategy can smooth out market volatility and potentially lower your average cost per share over time. Set up automatic investments if possible, and stick to your plan even when the market gets choppy. As your investments grow, your initial allocation may shift. Regular rebalancing, say once or twice a year, can help maintain your desired risk profile. Consider rebalancing with new contributions rather than selling existing investments to minimize potential tax implications. Remember, this approach is about the long game. Don't get caught up in day-to-day market movements. Instead, focus on your long-term goals and trust the power of compound growth. By concentrating on just 2 ETFs, you're creating a diversified portfolio that has the potential to perform well over time. Keep in mind that building wealth is a journey. With patience and consistency, you can work towards your financial goals using this straightforward 2 ETF strategy. In our next section, we'll explore how to tailor this approach to your unique financial situation. The 2 ETF strategy offers more flexibility than you might think. While its core strength lies in simplicity, you can customize it to fit your unique financial goals. Let's explore how to tailor this approach to your specific needs. For income-focused investors, consider swapping one of your ETFs for the Schwab US Dividend Equity ETF, SCHD. Known for its high yields, it's an excellent choice if you're looking to generate regular income from your investments. On the growth side, you might lean more heavily into the Invesco QQQ ETF or pair it with another tech-focused fund to capture more upside in high-growth sectors. If aligning your investments with your values is important, ESG ETFs are worth considering. These funds focus on companies meeting specific environmental, social, and governance criteria. By incorporating an ESG ETF into your 2-fund strategy, you can invest in companies that match your ethical standards without overcomplicating your approach. Your age and risk tolerance should also influence your ETF choices. Younger investors might opt for a higher allocation to growth-oriented ETFs, while those nearing retirement might shift towards more conservative options. For a balanced approach, consider pairing the Vanguard FTSE All-World ETF, VWRP, with a bond ETF. This combination provides global equity exposure while managing risk through bond investments. As you customize your 2 ETF portfolio, remember that the goal is to find the right balance for your situation. Avoid the temptation to overcomplicate things. Instead, focus on selecting ETFs that align with your financial goals, risk tolerance, and values. This approach allows you to maintain the simplicity of the 2 ETF strategy while tailoring it to your specific needs. By thoughtfully customizing your 2 ETF portfolio, you can create an investment strategy that not only serves your current financial situation, but also adapts as your needs evolve over time. This flexibility ensures your investments remain aligned with your goals throughout your financial journey. As we wrap up our exploration of 2 ETF investing, let's consider the power of simplicity in building wealth. By focusing on just 2 carefully chosen ETFs, you can potentially match or even outperform more complex strategies while keeping costs low and stress levels manageable. This approach helps you avoid common pitfalls, capture broad market returns, and minimize fees, all crucial elements for long-term success. The beauty of the 2 ETF strategy lies in its straightforward nature, making it accessible for investors at any level of experience. Looking ahead, consider how this streamlined approach might align with your financial goals. The investing world is constantly changing, but the principle of less is more remains a powerful tool in your financial toolkit. As you move forward on your investment journey, remember that simplicity can be a key ally in reaching your financial objectives. By embracing this approach, you're setting yourself up for a potentially smoother and more effective path to build wealth over time.